Okay, so Ray Dalio, the manager of the largest hedge fund in the United States, recently gave an interview and he explained his thoughts on the market today and how us smaller investors should be investing our money in the current market. So, as you know, I'm a big fan of Dalio and I've broken down his opinion on the market in previous videos. Well, today we'll be looking at what he thinks now and if his thoughts have changed since the last video. So, let's get straight into it. Well, this first clip shows Dalio giving some general advice to us regular investors, but as we continue, he gets more and more specific with his advice, so make sure you stay tuned until the end.
The investment environment going forward will be very different from the environment of the past. I mean, think about it as a zero and very low returning asset environment because the liquidity that's in the market is driving the excess returns of all markets down to be low in relationship to the very low cash rate. So negative real returns, not good for cash and so on. The most important thing is to know how to diversify well. And what I mean by that is to go beyond just the traditional 60-40 stock bond mix or even the same countries and to broaden that diversification. To include in that portfolio assets that might seem unusual, to include some gold, to include inflation index bonds, to think about the currency exposure, to think about safety as different. Most people think that cash is safe. Cash is the least safe investment. It just doesn't have the same volatility to it, but it has, because they're producing so much cash, it has a negative real return. It's a tax that maybe 2% a year you lose money in terms of cash. So you have to think about risk differently and you have to diversify best. That's the most important thing, to have a well-diversified portfolio. The uncertainties that we have today are so great in terms of all the things I mentioned, the tax policies, the geopolitical. Certainly we must experience it with the virus. Will the next wave come back and how will it be there? Diversification can be achieved without reducing your expected returns because of the way that asset classes are priced.
So Dalio raises a few key points. He starts by saying that real returns for most investments are likely to be low in the coming years. In fact, in recent times, he has said that the stock market could have a lost decade, which is him essentially saying that he believes the market will crash and may take 10 years, a full decade, before it returns to the kind of levels we're at today. Now, personally, I'm certainly not bold enough to make such a prediction, but I would say that it's pretty clear looking at the stock market that over the past, say, at least 6 months and longer really, it has been quite high. I mean, if we look at the historic chart for the American stock market, we can see that the level, even after March's crash, is well above the dot-com bubble and the peak before the mortgage crisis. Now, of course, you could argue that companies are making more money today, so they should be valued higher, and that is a very fair point. But this chart, the Shiller PE ratio, is a measure of how much companies are worth compared to how much they make. Today's figure of 29 is roughly double the historic average, which means that companies today are valued twice as much for the same earnings as they would historically have been. And again, that does seem pretty high to me. So listen, you could argue points for and against why the stock market is overvalued or undervalued, for why a crash is just around the corner, or for why the market is headed higher. But I think what we can all agree on is that the stock market is maybe unlikely to continue increasing for the next 5 years at the same rate that it has over the past 5 years. Not that it won't increase, but not necessarily at the same rate. And as a result, we can probably agree that Dalio's points on returns being lower over the next few years is a fair one. And here's the thing, once you realize returns are going to be low, how you think about investing kind of changes. Instead, we should begin to think defensively. We should begin to think about protecting our money first and foremost. And this is, of course, where diversification comes in. By the way, a quick note here. I've talked about diversification a lot in recent videos. This video is not a repetition. Dalio has a unique viewpoint on it, which we will be talking about. And for those of you who frequently quote Warren Buffett's opinion on diversification, I've read all your comments and I've listened to your voices, and as a result, I'm going to be dedicating a video to this topic shortly. But let's quickly remind ourselves what diversification is. Diversification just means not putting all of your eggs in one basket. It means not being 100% invested into stocks or real estate or bonds or any other investment. It means spreading your money between different types of investments. That way, if one of them crashes, you won't lose out so badly, as your other investments should retain their value or maybe even grow over time. So the question is, how do we diversify our money? Well, in normal times, you could create a portfolio with, let's say, 60% stocks and 40% bonds. And the truth is, that would be decently diversified. Okay, sure, it's not the most diversified, but if you include a large range of stocks and bonds, it's actually not bad in normal times. But Dalio is saying that this doesn't work so well today. As he mentions, we have enormous risk. We have the possibility of a second wave. In fact, in some places, they're still really in the midst of their first wave. We have geopolitical risks, and with an upcoming election, there is more uncertainty than ever about changes to tax policies. So the typical methods of diversification are not sufficient. Dalio believes we have to think more in depth. We have to think about hedging our bets with investments, such as gold. But most importantly, because times are riskier today than ever, we should think of diversifying our investments more today than we ever would normally. And I think this kind of conceptually makes sense. When things are maybe safer, it makes less sense to be as diversified. Maybe you can take a risk and try to get higher returns. But obviously, when there's more risk, more diversification and more safety makes sense. If you just look around at the world, we can quite clearly see there is a lot more risk today than there has been in many times throughout history. Let's hand it back over to Dalio to discuss more specific points for us to learn from.
And then if you're going to take tactical bets from those, then those tactical bets, alpha on top of that strategic, well-diversified portfolio, should have highly diversified bets deviated. Liquidity is going to be more important than before because things change in unexpected ways. Look at how, in many of the cases, the businesses that one would have thought was a good business, and let's say you're in private equity, and that you're with that company. And so the restructuring, the ability to rebalance and diversify and to be cautious about making a highly diversified set of bets is, I think, the future. But thinking even of asset classes, thinking about the value of money. You know, we look at asset classes and we say, oh, do I want my money to be in stocks and which stocks? But we don't think about stocks, bonds. We think about those traditional asset classes, but we don't think about the value of money and what's going to happen in terms of the printing of that value of the money and how to diversify it well. So I think those are the things that have to be paid attention to in much as they were important things in years prior to 1945.
So Dalio discusses the need for tactical bets to be diversified, and I think this is so important. You've probably seen the rise in recent months on YouTube of people making videos saying, you should buy this new share. These videos seem to be everywhere I look at the moment. And listen, there are some people who are smart enough to pick winners in the stock market. So it's not fair to group everyone together. Also, I'll hold my hands up and say I've used some pretty clickbaity titles and thumbnails here on YouTube. Even if I do generally always conclude that you should trust the science, data, and diversification and not my judgment, hence I tend to stay away from individual shares. But here's the thing, if we want to purchase individual shares, if we want to make these tactical bets, Dalio says we should do so within a diversified mix of investments. In other words, do not go all in on a few shares. Now, personally, I like the idea of taking, say, 5% of a portfolio and committing it to more risky investments. It is fun to play around with, but also it's not the end of the world if you lose it all, because it is only 5%. It's not like risking 100% or anything close to more risky investments. Now, Dalio also highlights the importance of liquidity, and this is a big one. So liquidity in simple terms is how easy or difficult it is to buy or sell something. Let's say, imagine you walk into a room filled with 10 people who are all buying or selling the same item. Now, imagine a big hall filled with 1,000 people. With all else being equal, it should obviously be much easier to buy or sell something in the big hall. Dalio is essentially saying you should stay away from the illiquid markets, or the small room, and instead stick to the liquid markets, or the big haul, wherever possible. Now, going back to this idea of diversification, Dalio is asked about bonds. Specifically, he is asked that with interest rates being as low as they are bonds limited in their ability to provide their typical role of diversification for us investors?
Yes. But the interesting thing about that is when you look about when interest rates, let's say bonds, approach a zero expected return, clearly their ability to go up in value or interest rates to go down in value is limited, or in order to have the impact, one has to leverage those a lot, and that's not desirable. But clearly through history, and I studied the last 500 years of cycles, going back to the Dutch cycle in terms of the Bank of Amsterdam and that whole cycle. In all cases, central banks will print money and devalue money when they get in that course. The basic problem of a depression is basically a debt liquidity problem. And so always through history, the choice will be reflation, even when you hit interest rates in the way that we're seeing now. And so to understand that the nature of the diversifying asset has shifted to be of the sort that I'm describing in terms of other assets that at that particular time benefit from reflation, because it will be reflate or die. And so we will always see reflation. And that's why in history, you see that all currencies have devalued or died over a period of time, particularly in such periods.
So Dalio finished this clip by saying that the government will be forced with an option: reflate or die. What he essentially is saying is the governments must do everything in their power to avoid deflation. So you've probably heard of inflation, right? It's where the value of things goes up each year. Well, deflation is just the opposite. So in other words, items drop in value in each passing year. In simple terms, deflation is bad because it encourages people to not spend their money. For example, let's say you see a sofa that you'd like to buy for your house and it costs $500. Well, if it costs $500 today, but it would be $450 next year, you'd probably keep hold of your money and instead just wait for the price to drop. This mentality of not spending is bad for the economy, and as such, governments must push people towards spending their money. And this then changes the nature of how we diversify our investments. You see, in the past, the typical way you diversify is through bonds, but he's saying that today, bonds are not so useful. In fact, he adds that the ability of bonds to increase in value is actually limited as interest rates are already near historic lows, so the rates cannot drop much further. So if you're not aware, the price of bonds generally moves in the opposite direction to interest rates. So as interest rates drop, bonds are going to increase in value. Well, as interest rates are already so low, Dalio questions how much lower they can realistically go. Sure, it's possible they could be negative in the US in spite of the Fed regularly saying that they won't drop rates this low. But realistically, Dalio is recognizing that bonds aren't likely to increase much further in value because interest rates are beginning to approach the threshold of how low they can go. Dalio further expands on this.
A bond or debt is a promise to receive currency. You're long the currency by being long in the bonds and so on. And so when debt is built up, and a lot of debt has been built up, but beyond debt, there's a lot of non-debt obligations, pension obligations, healthcare obligations, a lot of spending obligations. Those are like debt. And they all have to be met. And there won't be defaulting on that. It's politically unacceptable to default on pensioners and so on. So all of those obligations, insurance obligations, all of those liabilities are coming at us. And that then can be met increasingly by the printing of money. And so think about it. When you're holding a bond and it has no return and a negative real return, do you want to hold that asset? who is going to hold that asset, particularly when there's so much printing of money. And that is the value, that is currency, that is cash. And so that issue, that risk, that there's a movement out of that is significant. So now we have to look at historical periods of when that were analogous to what's going on now. And that would, I think, be particularly the war years. The years when there are large deficits that are built up, there's the monetization. And so when we talk about yield curve control and interest rate controls and guidance, we're in a new world.
As Dalio notes, if you buy a bond, you are loaning your cash to someone else so that they'll pay you cash in the form of interest payments. Well, if you're looking for a payment in the form of cash, then you're also somewhat dependent on what happens to the value of cash. If cash loses value, then the bond is going to lose value too, right? After all, a bond, as Dalio puts it, is just a claim to future cash. Well, in that sense, the link between bonds and cash is pretty clear. And Dalio goes on to highlight that the government doesn't have the ability to pay off big debt obligations, things like pensions. But you can't exactly not pay people their pensions either. That would be political suicide. So according to Dalio, the only solution the government has is to print more money. The more money they print, the less each dollar bill becomes worth. And because bonds are tied to money, bonds now look less attractive too. So before anyone comments on inflation not being as simple as more money means each dollar is worth less, I know it is much more complex than this. But if all else is equal, a higher number of dollars in circulation generally is likely to lead to a weaker dollar. And I am just trying to summarize Dalio's views on things in this video. So this is Ray Dalio's thoughts on why bonds are not good for diversifying. But to be honest with you, his outlook on the market is probably the bleakest I've found in my research. I mean, I'd say that most of the world's top investors and billionaires are far less bullish than the standard retail investor. I mean, some of the billionaires are calling for a deep recession, maybe even approaching a depression. But Ray Dalio, on the other hand, is outright predicting that we are already in the early stages of a depression. Now, obviously, it goes without saying that Dalio knows 1,000 times more than me. So who am I to disagree with him? Honestly, there's not even a comparison in terms of the knowledge that we have. In fact, I'm not exactly bullish on the market either. But in my opinion, I believe at least, one of the best ways to get a decent feel for the market is to look at what many of the world's top investors are saying, and more importantly, what many of the world's top investors are doing. And I would say that the general consensus, maybe taking an average of their opinions, is certainly less negative than Dalio. So when it comes to holding cash and bonds, I actually think it's important to consider both. Maybe as a smaller proportion than in normal times because of Dalio's points, but I don't think it's best to completely get rid of them either. After all, Dalio calls for diversifying throughout the video. Well, selling 100% of your bonds or holding virtually nothing in cash isn't really diversifying either. Let's not forget, diversifying is not putting all of your eggs in one basket. Well, the flip side of that is it means it's also not taking all of your eggs out of one basket either, not taking all your money out of bonds or cash. So you're probably wondering how you can diversify and which specific investment types would work well in today's market. Well, I recently recorded a pretty extensive breakdown of the investment types I like, including the ticker symbols with specific options and actual percentages to go with each category. I tried to really be as specific as possible. You can check it out by clicking up here. And of course, thank you for watching.